Shares of SoFi have jumped on Monday. Shares were up as much as 10% early in trading. As I'm recording, they're up about 8%. And the reason is the company announced a new $2 billion facility for personal loans. This could be funds SoFi could use to expand its personal loans business, or it could just simply reduce the credit risk that the company has on its financial statements. So I'm going to dig it through exactly what the impact is going to be, what this news was, why investors are so excited about it. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with the news first. This is a look at the release that came out this morning. SoFi expands loan platform business with $2 billion agreement with Fortress Investment Group. This is one of those big investment companies, has all kinds of products, all kinds of funds that they're running, but this is a really big facility, and this is going to be specifically for personal loans. That's what's called out here. What CEO Anthony Noto said is SoFi's loan platform business is an important part of our strategy to serve the financial needs of more members and diversify towards less capital intensive and more fee-based sources of revenue. That's, I think, the big takeaway here. SoFi wants to look less like a bank and more like a banking platform. They want to have fees, not manage risk. That they don't want that necessarily to be their business in the future. He said that he goes on to say they're pleased to see continued strong demand for SoFi's loan platform business, Fortress's collaboration, seamless execution, and appreciation of the platform value proposition makes them an exceptional partner. So why is this such a big deal? I think this goes back to SoFi's original strategy. They really started as a personal loan business. This is a look at their segmented financial statements, and you can see that student loans, goes back to 2021. Student loans was actually the biggest business back then, followed by personal loans. That has really changed over the past few years. The personal loan business is now really the largest business for SoFi. The reason that that's important is because I think this is a Trojan horse for SoFi. These are the loans that traditional banks don't want to give. They don't really want to be in the personal loan business. So SoFi says, hey, I'm going to build this relationship with customers. I'm going to get to understand them, understand their credit worthiness, and then I'm going to make it really easy for them to take out a personal loan. Most of these customers have very, very high credit, and they just need $10,000, $20,000 for a relatively short period of time. These are not 10 or 20-year loans like you would have with something like a student loan or a home loan. The problem for SoFi growing in that business is you have to have the actual capital to give those loans out. And this is where net interest margin comes in. That's what NIM stands for here at the bottom. So what we have here from left to right is total interest-bearing assets, and this is going to be their deposits and the debt that they have on the balance sheet. So you can see that there's about $22 billion worth of deposits, nearly $3 billion worth of debt. That gives you $24.9 billion of interest-bearing liabilities. That is used to pay for the $28.5 billion worth of interest-earning assets. Those assets are the loans that they have given out. That is an asset for a bank. So their interest rate that they're charging for those loans, remember those are personal loans, there's going to be a little bit higher interest rate than you would typically have. So higher than a mortgage, higher than student loans, but lower than you would get from a credit card. That would be the reason that somebody would want to take out a loan like this. That's 9.53%. The interest-bearing liabilities, 4.24%. So your net interest margin is 5.83%. That's the spread. That's the amount of money that SoFi is making. But then the other thing you have to consider is losses, potential losses. This is the thing that's been a little bit concerning. Over the past few quarters, you can see that going back to 2021, you have a 90% delinquency rate for most of these loans in the 0.2, 0.3% range. That has jumped to 0.7% in Q1 and 0.6% in Q2. That's important because SoFi has these loans on the balance sheet. What this $2 billion agreement does is it says Fortress is taking on the risk now. So SoFi will be the company that's originating the loans. Fortress is going to be taking on the risk. SoFi just gets to get a fee for that origination process. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This is important for a couple of reasons. One of them is SoFi a technology company or is it a bank? It's a little bit of both right now. But if they're going to offload the risk to other investors, that means that they can act more like a technology company. That will also allow them to leverage the business and grow the business more quickly because capital is no longer a constraint for growth. With a traditional bank, your capital is your constraint. So if somebody wants a home loan or a personal loan, you have to have money that you can actually give them. That means you have to have deposits on the balance sheet, or you have to have debt, or you have to have equity. So this is the challenge that banks often have. Okay, we want to grow our bank. How are we going to do that? Are we going to issue equity to have more tier one equity? Are we going to take out more debt, take on more risk? How do we increase our deposit base? There's really this dance that banks often do in trying to manage their risk and grow their assets, because that's ultimately how they grow their earnings. But if you don't need to grow the assets on the balance sheet to grow earnings, because you're just getting fees from each loan that you're giving out and then you're offloading that risk to somebody else, that's a much more scalable position to be, a much more digital centric position to be. And there are plenty of investors out there who just want to take on the debt piece. They just want an interest payment year after year, quarter after quarter. So if SoFi can handle the risk part, and they say, here's the risk profile of 10,000 loans, here's what you can expect to get back as an investor, and then they're able to live up to that, they can have basically the same infrastructure that they had before, but they're not putting their own capital at risk. That's why I think the market is reacting so positively to this. Anthony Noto has been positioning this company for years to get to this point where they can offload that bank risk to somebody else, and they can just be the platform company. So now lending becomes a platform, the technology business is already a platform, and the financial services business already looks a lot like a platform as well. In most cases, SoFi is not really taking a lot of risk in the financial services business. Yes, it takes some capital to offer things like margin loans, but it's not the same as giving somebody a personal loan. It's not the same risk profile. And the technology platform and financial services have really been the growth driver for SoFi over the past few years. You can see here that in 2019, basically these two businesses did not exist. Now they're generating over $900 million in revenue per year. So this is going to be the strategy for the lending business as well. Can this become a much more capital light business and be just as profitable and even more scalable for SoFi? This could really increase the company's growth potential long term. And I think that's really the way to interpret this. If we see more deals like this, we could see SoFi's balance sheet look even more attractive and their growth pick up as a result. Now, this is a stock I own. Shares have been doing pretty well over the past 6 months. Shares are up about 36%. I think that run can continue. They're going to be reporting earnings on October 29th before the market opens. So this is one I'm definitely going to cover here on Asymmetric Investing, because I think it's one of the best potential growth stocks in the financial sector right now. But let me know what you think about SoFi, about this news, this new $2 billion facility, and the potential strategy shift to a more fee-based structure than they've had in the past. Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.